How the rich use debt to build wealth. Most people fear debt, but the rich see it as a powerful tool. Instead of avoiding it, they use debt strategically to acquire assets that generate cash flow, like real estate or businesses. While bad debt keeps you stuck in payments, good debt allows the wealthy to grow investments, lower taxes, and multiply their wealth. Today, let's break down how the rich use debt not as a burden, but as a wealth-building weapon. So before we start, make sure to hit the like button and subscribe to my channel. 1. Debt. A tool, not a trap. When most people think of debt, they picture credit card bills, payday loans, or mortgages that weigh them down for decades. This is what's known as bad debt. Borrowing money to purchase liabilities that don't generate income. The rich, however, look at debt from a completely different perspective. For them, debt is a financial tool, not a trap. They understand that banks and lenders exist to provide leverage, and leverage, when used wisely, can accelerate wealth building. Unlike the average person who borrows to consume, the wealthy borrow to invest. They take advantage of other people's money to acquire assets that appreciate in value or generate steady cash flow. This shift in mindset, seeing debt as an enabler rather than a burden, is one of the biggest reasons the rich grow richer. They recognize that the real cost of debt isn't the interest rate alone, but whether that debt funds something that produces more income than it costs. By borrowing to buy appreciating assets like rental properties, stocks, or businesses, the wealthy turn debt into a wealth amplifier. In their world, debt isn't about survival, it's about strategy. 2. Good debt versus bad debt. One of the first principles the wealthy understand is the difference between good debt and bad debt. Good debt is money borrowed to acquire or build assets that increase in value or generate income. Examples include mortgages on investment properties, business loans, or even student loans for high-value education. Bad debt, on the other hand, is borrowing for things that depreciate or don't generate income, such as cars, luxury items, or credit card spending. While most people are buried under bad debt, the rich avoid it or minimize it aggressively. Instead, they focus on good debt, knowing that it can work in their favor long-term. For instance, a wealthy investor might take a $500,000 loan to buy an apartment building that produces $5,000 a month in rental income. Even after paying interest and expenses, they generate positive cash flow, meaning the debt funds itself and produces wealth. Over time, the property appreciates, the tenants pay off the loan, and the investor builds equity. This is how debt transforms from a liability into an asset. The rich master this distinction, which allows them to grow wealth while others struggle. 3. Real estate and leverage. One of the most common ways the rich use debt to build wealth is through real estate. Unlike cash purchases, leveraging borrowed money allows them to control large assets with relatively little of their own capital. For example, putting 20% down on a rental property and borrowing the rest means they only risk a fraction of the asset's value, yet they benefit from 100% of the appreciation. If that property increases in value by 10%, their return on investment is far greater because they only invested a small portion up front. On top of that, tenants' rent covers the mortgage payments, effectively allowing others to pay off the debt. This strategy is called leverage, and it is one of the wealthiest individuals' favorite tools. Wealthy real estate investors scale this by using debt strategically to build large property portfolios. They refinance existing properties, pull out equity, and use that borrowed money to purchase even more assets. This cycle of buying, leveraging, and reinvesting allows them to grow wealth exponentially over time, all while minimizing how much of their own money is at risk. 4. Business financing. The wealthy often use debt to build and expand businesses, another key pathway to wealth creation. Rather than saving for years to fund a new venture, they borrow capital to start or scale quickly. Debt in business is not seen as a burden, but as fuel for growth. Business loans can fund new equipment, marketing, staff, or product development, all of which generate higher revenue. Successful entrepreneurs understand that if the return on investment from borrowed money exceeds the cost of debt, they win. For instance, borrowing $1 million at 6% interest may sound risky, but if that loan allows the company to generate $2 million in additional profits, it's a smart move. Moreover, businesses often use lines of credit, revolving loans, and vendor financing to manage cash flow and maintain operations without tying up personal capital. Large corporations like Amazon, Tesla, and Apple use billions in debt not because they lack money, but because borrowing provides liquidity and scalability. Wealthy individuals apply the same principle on a smaller scale, using debt as leverage to fuel business growth and wealth creation. 5. Tax benefits of debt. Another often overlooked advantage of debt is how it helps the rich minimize taxes. While the average worker earns income that is taxed at the highest rates, wealthy individuals structure their finances so that debt works in their favor. For example, mortgage interest, business loan interest, and certain investment-related interest expenses can be tax-deductible, reducing taxable income. In real estate, depreciation combined with mortgage interest deductions often allows investors to show losses on paper, even while generating positive cash flow. This means they can grow wealth while paying less in taxes. Additionally, borrowing against appreciated assets like stocks or real estate provides liquidity without triggering taxable events. If a billionaire sells stock, they owe capital gains tax, but if they borrow against it, they receive cash while keeping the asset intact and untaxed. This is a powerful tax strategy used by the ultra-wealthy to fund their lifestyles and investments while minimizing their tax liabilities. Debt, when structured properly, not only creates wealth, but also protects it from unnecessary erosion through taxation. 6. Using other people's money. At the core of wealth building with debt is the concept of using other people's money. The rich understand that their personal money has limits, but debt allows them to control and grow assets far beyond their own means. Every dollar borrowed can potentially work harder than a dollar saved if invested properly. For instance, borrowing $200,000 to invest in a cash-flowing property may generate far greater returns than saving for years to buy outright. This principle is not limited to real estate. It extends to business, stock investments, and even venture capital. By leveraging other people's money, the rich multiply their opportunities and accelerate wealth accumulation. Other people's money also creates diversification. Wealthy individuals can spread their borrowed capital across multiple income-producing assets rather than tying up all their money in one. The average person sees debt as a risk, while the wealthy see it as leverage. With careful risk management, other people's money becomes the fuel that builds empires. 7. Risk management. Of course, debt carries risks, and the wealthy understand this better than anyone. What separates them from the average borrower is their ability to manage risk effectively. They don't borrow recklessly. Instead, they analyze cash flow, interest rates, and potential returns before taking on debt. The goal is to ensure that borrowed money generates more income than it costs to repay. They often structure loans with fixed rates, favorable terms, and contingency plans. They diversify their investments to avoid being overexposed to a single source of debt. Moreover, the wealthy use legal entities like limited liability companies or corporations to protect themselves from personal liability in case of defaults. Risk management is critical because leverage can amplify both gains and losses. While the poor often fall into debt traps due to lack of planning, the rich treat debt as a calculated tool. They understand that controlled, strategic borrowing is not reckless, it's essential for scaling wealth. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.